This week, these are 5 mistakes reverse mortgage borrowers should avoid.
Building relationships is the way Mutual of Omaha has grown into one of the leading financial services companies in the world. Our reverse mortgage wholesale division is proud to carry on this 100-plus year tradition. To your borrowers, a reverse mortgage is more than a transaction. It's a promise of a better, more stress-free life. Our goal is to provide you, our valued client, with the best service and support possible so you can focus on helping your borrowers achieve the retirement of their dreams.
Welcome back to the Industry Leader Update. There are many pitfalls reverse mortgage borrowers can fall into, and most have nothing to do with the loan itself. Many of you, our viewers, have had a front row seat in watching reverse mortgage borrowers exhibit some of the strangest and irrational behavior. Personally, I'll never forget the time that I pulled up to an applicant's home to find a brand new RV parked in their driveway. Now, they were just in the application process to get the reverse mortgage, but the loan was weeks away from closing, and by far it was not a certainty. "When did you get the RV?" I asked. "Just last week," answered the husband. I came to learn that they were counting on the proceeds of that reverse mortgage as if it was already money in the bank. That shows previous behavior. Now, I was mortified, which brings us to the first mistake that some reverse mortgage borrowers make, and that is using the loan proceeds too quickly or even all at once. While the adjustable rate HECM or home equity conversion mortgage does allow for a borrower to have unused proceeds in what many call a line of credit or the principal limit, some borrowers immediately go on a spending spree with no thought of possibly needing those funds for a future health emergency or a financial shock. And that could leave the borrowers at risk of foreclosure if they end up without the funds needed to pay their required property charges. However, beyond the wild-eyed spendthrifts we encounter, there are other potential pitfalls every reverse mortgage borrower should avoid. And the second one is to avoid rushing into the loan. Now, we have pushy salespeople in every industry that can pressure someone to act quickly, but there are actually times when the homeowner themselves are moving ahead too fast. And while required HUD counseling and also ethical originators like yourself can help mitigate a hasty decision, homeowners may be motivated to act quickly out of an immediate need or urgency. Now, as a result, they may not disclose that they have a roommate or a relative who actually lives with them that could be forced to move when the last borrower dies. Another possibility is that they need access to those funds immediately and they're disregarding the true cost of that reverse mortgage because they know, and they haven't told you, they're going to be moving in just a few short years. The third mistake is that reverse mortgage borrowers disregard the potential risk that their spouse may face in the future. But let me be more specific. We're talking about non-borrowing spouses that are named on the reverse mortgage. Now, the non-borrowing spouse should know that while they may continue to live in the home following the death of their partner, their access to future line of credit withdrawals or 10-year payments could be stopped. And the primary borrower should actually be planning ahead on how their partner will be provided for in the event that they predecease their non-borrowing spouse. The fourth mistake to avoid is to ignore home maintenance and upkeep. One of the key provisions of a reverse mortgage is that the borrower must continue to maintain that property or home to prevent deterioration of it because it helps secure the loan. And they also must make sure there are no health and safety issues. The fifth mistake for reverse mortgage borrowers to ignore is increasing property taxes and homeowners insurance premiums. HECM borrowers that have a lifetime expectancy set aside, or what we call a LESA account, must understand that the LESA payments are not guaranteed for as long as they live in the home. And while that LESA account does anticipate future property tax payments over the borrower's life expectancy, when you have rapidly increasing property taxes or homeowners insurance premiums, those can actually exhaust that account prematurely. That leaves the borrower to resume making those property charges right out of their own pocket. Now, a traditional or a reverse mortgage for that matter, these are not risky loans in themselves. However, a borrower's behavior before and after the loan, that will shape the trajectory of their success or failure. Now, what are your thoughts? Leave your comments in the comment section below. And if you'd be so kind as to share this week's video on LinkedIn, a shout out to my friends that do that each week. Don't forget, we have a YouTube channel. Be sure to subscribe and hit that like button. It helps improve our SEO and our rating inside of YouTube's algorithm. And each and every week, you can catch up on your reverse mortgage news by simply plugging in your headphones. You can find us here at HECM World or on iTunes. We're now on Spotify, and we're also on podbean.com. That's a wrap for us here. Until we see you next week, happy originating.